Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem related to a consolidation where we have a parent-subsidiary relationship, parent owning over 51% but not 100% of the subsidiary. Therefore, we're going to have a non-controlling interest we will have to be dealing with. We also have a situation, one of the major situations we want to focus in on here, where the parent is purchasing the subsidiary bonds from a third party. In other words, subsidiary issued the bonds not to the parent, but then the parent purchased the bonds from a third party. Also, that purchase is taking place in the current year that we will be consolidating. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have the information on the left. We're going to be entering that information into the blue area on the right, where we have our worksheets on the right, and we have our journal entries we're going to be entering, and our consolidation entries or worksheet, where we have the parent and subsidiary trial balances as of the point in time that we will be consolidating, and we'll be entering our consolidations over here. We're then going to go back to the left. Let's see what we have in our information. P purchased a percentage of S voting common stock on January 1st, 2000 X5. P parent, S subsidiary, the percent, 90%. The cost of that purchase in 2000 X5 was $1,108,800. Then the non-controlling interest fair value at that point in time is $123,200. That's the amount of the non-controlling interest. We then have S net assets at the point in time of purchase, which are assets minus liability, or net assets, equity section, $1,152,000. Book value and fair value of S are the same except for, in other words, at the point in time of purchase, assets and liabilities, if we were to go through them, they're the same except for the land, which is higher by the $30,000. That's going to be a differential we'll have to be accounting for within our consolidation. And then on April 1st, 2000 X6, P issued bonds to S at par. So we don't have any premium or discount to deal with because they were issued at par for $200,000. The rate's going to be 10%. That's going to be a more straightforward type of transaction here because it was an issue from P directly to S. Therefore, the two sides of these transactions should mirror themselves very nicely. We will compare and contrast that to also note that the interest paid March 31st and September 30th, that whenever you see that, it's not like at the end of the year and the beginning of the year. We have then an accrual entry we'll probably have to deal with as well. So we'll have some accrual entry we'll have to deal with. But other than that, pretty straightforward one. Then down here, a little bit more confusing. We have P purchased all of S outstanding bonds from an unrelated company, January 2000 X7. That's the current year that we're going to be consolidating in, 2000 X7. So this happened in 2000 X7. P purchased the S outstanding stock. So that means S issued these stocks, the bonds, issued bonds to someone other than P. But then P went out and purchased them from the third party, which kind of confuses things because when S originally issued them, they were the 1 million face, and they issued them at the premium of the 101. But then when P purchased them, they purchased them at a discount of the 98. So the rate is going to be the same because that's on the face of the bond. So we'll be taking a look at that. And then we have inventory, just to confuse things a little bit more. We have the inventory sales from S to P, S subsidiary, P the parent. So they're going to be upstream transactions. So we have the 2000 X6 sales that took place for sales price $66,000 and the amount not resold in 2000 X6. In other words, still in ending inventory at the end of last year. They're in beginning inventory this year. We expect them to be paid then this year. And then 2000 X7, we have the sales that took place intercompany from S to P, $81,000. Amount not resold at the end of the year, still reflected in ending inventory. Gross profit still reflected in ending inventory, $10,000. Gross profit percent is going to be that 30%. We're going to do the consolidation as of December 31st, 2000 X7. As of December 31st, 2000 X7, S declared but not yet paid dividends. So they had dividends that they declared, didn't yet pay. Therefore, there's going to be a receivable and payable that we're going to have to reverse out with relation to the dividends. Then we have the straight line depreciation and amortization. That's what's going to be used for the bonds. And if there's any depreciation, we're going to say that means the premium and discount are going to use in a straight line method. And then as of December 31st, 2000 X7, goodwill impairment loss of $25,000. So that means that's the current year that we're dealing with, 2000X7. That means we put goodwill on the books. We're going to calculate what goodwill was, and then it got impaired somehow by 25,000, so it's going to go down by 25,000. Then the fully adjusted equity method, that's what we're going to be using. All right, let's dive into this thing. So up top, we're going to have this is our journal entry that we're going to use to adjust the beginning or first journal entry that we'll have in our consolidation process. Let's get to that later. Let's first go down and do our calculation of goodwill that we'll typically do. Goodwill in like the differential calculation. This is at the point of consolidation. We're going to see if there was any goodwill involved here, which there should be, considering it was impaired, and we were told that. So we're going to say, all right, then the net assets are going to be the net assets at the point in time that the original purchase took place was the $1,152,000. Differential is going, or the difference between the fair value and the book value is this land. We had this land on the books, which was $30,000 higher. If we then add those two up, we're going to sum those two up. That's going to give us the $1,182,000. Then we're going to say non-controlling interest might be 10%, or they might just give us the non-controlling interest as they did here at the 1232. So there we have that. Therefore, the difference between the fair value minus what goes to the non-controlling interest would be what you would expect the controlling interest to be paying for, but unless there was some kind of goodwill. So you would expect that would be the controlling interest. But then how much did they actually pay? Let's just check it out to see if there is any goodwill. They pay the $1,108,800. Therefore, there is goodwill between the difference of them, and that goodwill is going to be $50,000. So the original goodwill was $50,000. We said it was impaired. Then later on, it was impaired by $25,000. It's going to go down to $25,000. Okay, keeping that in mind, we're now going to consider the next item here. Let's consider the inventory transactions. I'm going to highlight the ones we're working on the left in green so we know where we're focused. That's where our focus is right there. So then we're going to say the inventory transactions. Now, I put all the inventory transactions just so you could see, all the things that could be happening, and then we'll pick and choose which ones to use. Remember, you could have, P to S, S to P, or upstream and downstream, transactions in the prior year that you have to reverse, and then in the current year. So that's kind of like 4 types of things that could happen. So I've color coded those orange, yellow, green, and blue. So in other words, you could have downstream transactions, which are going to go from P to S. So that could happen in the prior year and the current year. That's not what we have here. So there's nothing that we're going to include in those items. And then we have the upstream transactions, which could happen in the prior year and the current year. So that's what we will be dealing with here. So we have the prior year upstream transactions. Let's deal with those first. We had sales that took place in the prior year of the 66,000. 66,000 of sales. Then they give us the gross profit percent. So we're going to say, all right, I know the gross profit percent. That means I can figure out the gross profit by taking the sales times the gross profit percent. And then we can back into the cost of goods sold by taking the difference between the two, or using the cost of goods sold percentage of sales, which would be 70%. So I'm just going to say the 66,000 minus the 19.8. There it is, the 42.2. Then they tell us that the amount not resold is 17. So I could then jump down to the bottom and say, okay, then this is the amount that was in ending inventory still at the end of last year, or in beginning inventory for the current year. That was the 81,000. And then we've got our same gross profit percentage down here. So we can take then, all right, well then we got I'm sorry, it's not the 81,000. What am I doing? No. It's the 17,000. So there it is. And then we're going to say, all right, now the 30% of that is going to be 5,100. We can then figure out the cost of goods sold, 17,000 minus the 5,1 gives us the 11,9. Then we can back into the amount that was resold. In other words, this is the amount of the sales, and this is how much was still in the ending inventory. So the difference is the amount that was resold, 66,000 minus the 17. Resold in terms of cost of goods sold, the 46.2 minus the 11.9. And then we can calculate this a few different ways. I'm going to take the 49,000 minus the 34.3. Then we can check to see if we still have that 30%, the 14.7 divided by the 49,000, still at that 30%. Okay, then we have the current year transactions, 2000X7, the year of consolidation that we're going to be doing. And we're going to say, all right, then the sales for this one is going to be that 81,000. Then we've got the gross profit percent at 30. Therefore, the 81,000 times 30 is going to be the amount of the gross profit, or the 24,300. Difference cost of goods sold, 81,000 minus the 24,300. There's our difference in the cost of goods sold. If we then go down to the ending inventory, because they gave us the 10,000 here, we'll do that first, and then we'll back into what was resold. We're going to take the sales item. So sales item 10,000, the amount that's still there, the gross profit percent, we're going to stay is still that 30%. So if we take that 10,000 times that 30%, there's our gross profit. Then we can back into the cost of goods sold, 10,000 minus the 3,000, 7,000. Then we can back into the amount that was resold, because this is the amount of sales. This is the amount that's still in ending inventory. So we're going to take the 81,000 minus the 10,000, and then the cost of goods sold, the 56,700 minus the 7,000. A couple ways we can do this one. 71,000 minus the 49,700. We can look at our percentage once again. 21,300 divided by the 71,000. Checking that our percentage is still valid, which indeed it is. Now we're going to use these, of course, to figure out part of this journal entry, or part of this transaction. That's going to be these first two items dealing with inventory. That we'll deal with, because there's an effect on net income, and this will basically reverse the net income kind of effect we'll have over here. Let's do a couple calculations with regards to a table type of format, and these will help us a bit both to understand this as well as think through our journal entries to post this information into our consolidation worksheet. So first, let's think about the gain on the constructive retirement of S bonds. So when we think about that, let's go on over to our data. And let's uncolor this one. I'm going to uncolor that. I'm going to color the one that we're doing right now. So we're thinking about this one. So this is the funny one. This is the one that's confusing, because they didn't issue them. They issued in P purchased bonds that S originally issued to someone else, and then P purchased them from the third party, which, they just shouldn't do that because it's confusing. But in any case, we're going to say now the original proceeds from the issuance of S bonds premiums amortized are going to be this. So the original proceeds when the original bonds went out, not between the intercompany transaction. We're going to say they originally went out from S to someone other than P, so nothing weird was happening at the 1 million times the 1.01, which is another way of saying 101%. They were issued at a premium of 1% over 101%. So I can't just click there because I don't want to put that in terms of a percentage, because I think I want to leave it the way you might see it, and then so times 1.01, 101%. Okay, and then that means the premium then is that amount that we got there minus the face amount, or the par value, or whatever is going to be the 1 million. So there's the 10,000 difference. We're going to divide that by the number of years. And so notice I'm not taking the periods, I'm taking the years right now, even though we have two payments. So if you're thinking about periods, like when you're calculating the period, or how much interest that's going to happen per payment, then you would do it by 20. But now we're thinking about in years here. So we're considering in years is 10, and the amortization then per year is going to be the 10,000 divided by the 10. So that's 1,000 per year. And then years to January 1st, 2000 x 7. So in other words, we had January 1st, x1, so x1, 2, 3, 4, 5, and then 6 years. So we have 6 years till 2000 x 7, right? We've got 1, 2, 3, 4, 5, and then 6. So we're going to go 6 years have happened up until this point in time, the current time that the purchase took place. So then we're going to say then that if we multiply that out, that means that we have the 6,000 times the 6. So we have 6,000 as the premium amortized to January 1st, the point in time that then P made the purchase, made that intercompany kind of purchase from a third party. So then we're going to say, well, here's the book value at the point they were distributed at the premium minus the 6,000, which is the amortization of the premium up to the point in time that P then purchased the bonds from the third party, and we get the 1,000,004. And then we're going to say, okay, well then how much? So that's how much you would think the bonds would basically be worth, at the point in time that P then purchased them from the third party. But how much did P pay for them? So we're going to say, well, P paid for them, these bonds, 100,000. They purchased them from a third party, but they paid that 98, which is, we read that as 0.98 or 98%. So they purchased them at like a discount of the 100. So we're going to say, all right, well then times 0.98. So that means there's a difference of the values here at this point in time, which we're going to call this gain on constructive retirement of S of that 24,000. So we're going to have to, when we reconcile this intercompany kind of thing, we're going to have to deal with that 24,000 difference, which happened in the current year because the purchase of the bonds from a third party by P that were originally issued from S happened in the current year. Okay, so now we're going to go to the income to the non-controlling interest. And basically what we're going to be calculating here is we want to think about this number, this 153, and adjust it to then, after the consolidation takes place, any adjustments that are going to be to it due to the consolidation, and break it out between the non-controlling interest. We're basically looking at the end result that's going to be here for this non-controlling interest number. Now note, this is kind of a duplicate calculation because we will be dealing with this over here a bit too as well when we think about that net income adjustment. But it could be useful to deal with this in terms of a table format. So we're going to recalculate this in kind of like a table type of format. So we're going to say, all right, let's start with the net income. Let's start with the net income for S. S's net income over here is the 153,000 net income for S. And then we're going to make some adjustments for that inventory. So the first one's going to be the 2000X6 intercompany profit realized in 2000X7. So we're going to say that's going to be equal to, we calculated this in our inventory. And notice we're taking basically the end number in our calculation because this is like the ending inventory, number that's ending inventory last year that's going to be, we would assume, sold basically in the current year. And then we got the constructive gain on retirement of the bonds, which is also going to be a positive over here at the 24,000. So we're going to have to deal with the 24,000. And then we have the unrealized intercompany profit as of 2000X7. So this is going to be the other deal with the inventory. So we're going to say, okay, that we did the prior year inventory, now the current year inventory. And this is going to be a negative now of that 3,000 that we calculated a bit ago. Now we want the portion of the constructive gain on the bond retirement recognized currently, and that's going to be equal to the 24,000 divided by 4. Now I'm going to make that a negative, and you might say, okay, well, where did the 4 come from? So I'm going to go back over here, and we've got the bonds were originally issued in 2000X1, and they're 10 years. So that means we got 2000X1, 2, 3, 4, 5, and then 6. And then we basically got 4 more years. So 10 minus the 6 is basically the 4 that we're pulling over for this calculation. Next, we're going to have the impairment of goodwill. So goodwill has been impaired in the current year. With the goodwill, you'll recall that we had the original goodwill that went on the books. That was before, prior to this, when the actual consolidation took place of the 50,000. But then it was impaired down here by the 25,000. So we're looking for that impairment because that's going to result in a loss that's going to affect like the income statement. So we're looking for how much it went down by in the current year, which is going to be that 25,000. So we're going to be picking up that impairment. I'm going to say negative of that 25,000. So we'll pick up that 25. And then we're going to be adding this up. This is going to be the adjusted income now that we're going to be allocating out. And I'm going to sum this up. So we'll add this up. That's where we started, and these are the adjustments we made. We're now at the 148,100. Now we're going to take our non-controlling interest of it, which I'm going to calculate this way. I'm going to say 1 minus, and we'll pick up that 90%. 1 minus the 90%, then being the 10%, the amount of the non-controlling interest. And then if I multiply that 148,1 that we're going to allocate to the non-controlling and controlling interest, we got the 14,810. That's going to be a recalculation over here of this item. Now note, we're going to do some of that recalculation once again with our original or first journal entry, which will be helped with this table, which will give us some of the activity in here, but not all of it. So we'll see that shortly. Now let's go to the interest income S bonds held by P. Interest income S bonds held by P. This is going to help us with the reversal entries to think about the interest calculation. So we're going to use this. We're going to use this when we get to our consolidation type entries. Now we're thinking here of this weird situation where, you know, P purchased S bonds, but again purchased them from that third party. So what's going to happen with regards to P's books when they're going to record this information? Well, they're going to be thinking, all right, the face amount of the bonds are the 1 million. The rate of interest is going to be that 12%. So we got the 12% on the interest, and that will come out to, if we multiply that out, we got the 1 million times the 12%. Now then we also have they basically have a discount on it because they purchased it at 0.98 of the face amount. So now we're considering this compared to basically the face amount, the normal kind of thing that you would be thinking about in terms of the discount premium kind of calculation. So we're going to be saying, all right, then we have the amortization of the discount. To do this, let's consider first what the discount actually is, and then we'll consider the amortization. So I'm going to stop here right now, and we're going to go back to that point. Let's consider now the premium amortization per year for S bonds held by P. So let's do that calculation. So I'm going to take the 1 million up top, the interest. I'm going to say 0.98. And we're going to take the 1 million times the 98%. So the purchase price then is going to be the 980. So the full amount of the discount at the point in time of the purchase was the 20,000. And then the years that are remaining, there's going to be 4 years remaining, I believe, right? Because it was 2000 X7. They originally sent in X1. So 1, 2, 3, 4, 5, 6. And then starting X7. So 10 minus 4, right? 10 minus 6 or 4. I'll do it this way, so maybe that'll help if you... so then we're going to say, then we have the 20,000 divided by the 4 time periods. That's going to be the amortization per year that they would think of the discount. Again, we're not considering the intercompany transactions. We're just saying what they would basically record on their books normally with regards to the bond. So then that would be the 5,000. So that means the interest income is going to be the sum of these items, or the 125,000. Now we'll look at this a little bit more in detail, because we're going to use these when we consider the journal entries, which we'll do now. Let's consider the journal entries that would have been recorded by P and S with regards to these intercompany bonds, which we have 2 of them now. So let's think first about the intercompany bonds up top. Let's first think about these ones, and then we'll go down to the more confusing ones. So I want to think about these in terms of kind of like the journal entries as a whole. Let's think about in a journal entry format what would happen for the recording of these bonds. So I'm going to say, all right, well, these ones are, there's no premium or discount we have to deal with here. The funniest thing that happens here is that there's this interest paid on March 31st and September 30th. And that means it didn't happen as of the end of the year, and you're going to have this accrual thing that's going to happen. And the accrual you would expect then to be for the last 3 months, October, November, December, where interest would have accrued and wasn't paid. So we would expect to see an accrual. Now, the good thing about this one is that accrual is kind of a problem. It's a little bit more of a twist, but the good thing about it is these were issued directly from one to the other. Therefore, the entries on P side should mirror S's side quite well. So we're going to say, all right, let's first think about that accrual. We're going to have to reverse the prior year accrual that we would have, which would be something like interest payable would need to go down for P side of things. And then we'd have to say they'd be paying basically the cash. This would be part of basically the cash payment of the current year to reverse basically the accrual that took place last time period. Calculation would then be, we're going to say that we have the 200,000 times the 10%. That would give us basically the interest for an entire year. I'm just going to divide that by 12, which would give us the interest rate. So now we're up here. This is what we have thus far for a month. And then we have 3 months that were accrued in the prior year that we're going to say times 3, and that would be the 5,000. So we're going to have to reverse out the 5,000, and that's going to be part of what we pay in the current year. And then I'm going to record the second transaction kind of lumped together. Notice we have payments happening, 2 payments, March and September. I'm going to kind of group them together just in journal entry format to say what would happen during the entire year on like a yearly basis. Well, we would have then interest expense. So let's think about the interest expense. I'm going to say, all right, we got an expense in the current year. Where am I going here? I don't know. I'm just going to type in interest expense, and that's going to be the debit. I'm going to calculate that. Current year's interest expense should be the 200,000 times the 10%. That's the interest expense for the current year that we would expect, just like in total at the end of the year. Then we're going to have a payable for that 3-month time period, same 3-month time period, but now it's the end of the year. So you'd have October, November, December that we'd have to make an accrual for at the end of the year. And that would be in something like the interest payable, which would be going to the interest payable. It would be for the same calculation, but now for the end of the year, so it'd be going back up for the payable. And then the difference would be the cash. I'm going to say negative sum. So I know I didn't do this in terms of a journal entry by journal entry, but you could see the total cash that would be paid would be the 15 and the 5. But we did it in terms of reversing basically the prior year accrual, and that the cash being the 5, and then recording the interest expense for the entire year and the current year accrual that would happen in the current year. Okay, and then on the other side, you'd have a mirroring of that. So on this side, you'd say, all right, on this side, you'd have an interest receivable, and that would be a credit of this amount, and then we'd have cash. And so I'm just reversing same accrual adjustment on the other side of the books. These will mirror very well because, again, they were issued directly to each other. So then we're going to mirror this one, and I'm going to say this will not be interest expense but interest income. It's going to be a credit, and then it won't be the interest payable but interest receivable. Receivable. I don't know. Did I spell that right? I don't know. Then that's going to be the debit for the accrual portion, and then the cash negative sum should be that, and there's the 15. All right. Now let's think about the more complicated one that's not going to mirror as well. So ungreen this one. And we're working on this one now. So this one's a little bit more complex because, again, it won't mirror exactly due to the fact that we have that intercompany, third party involved here. So we're going to say, all right, on P side of thing, P purchased all of S outstanding bonds. So P is going to be the one that's going to be receiving cash. So we're going to say, all right, P would be getting in the current year. We're going to say, and again, I'm going to group them together as like, in a journal entry format, what happened for basically the entire year here. We'd say, all right, well, they would have got this times 12% on the cash side of things, and then they'd have to decrease their, they would have to record to their investment in bonds. They'd have to actually increase that because because they bought it at a discount, and that needs to be up to 1 million at the end of the time period. So they will be increasing that, and we're going to be calculating that. That's where this calculation came down below. the 5,000. So that's going to be the 5,000 that they'll be increasing, you know, like over the 4 time periods, just normal kind of process to get that up to the 1 million. So it'll match what will be paid at the point of maturity. So then I'm going to say negative sum on this side is going to be the 125, and that's going to be the interest income. Now, the funny thing down here, well, what's S going to do? S isn't going to do like the exact same thing because they issued it originally at a premium. So on their books, what they would have done, and this is what part of what we'll have to kind of adjust for in our consolidation, what would they have done? Well, they would have said cash would be the same calculation here. And then, but then they have it on the books at a premium, not a discount. So they're going to have to decrease the premium. So I'm going to say the premium is going to be here, and that would be a debit to the premium going down of, and I think we calculated it over here somewhere. I think it was 1,000. Oh, there it is. Let's pick up the premium for 1 time period, the 1,000. And then the difference is going to be, for their side, interest expense. And then negative sum. So there we have it. So that's kind of a little bit awkward there because it doesn't mirror like you would expect. Cash still good, but then this side doesn't match up because again they weren't issued directly to themselves, and that's why we have this 24,000 gain on constructive retirement thing that we're going to have to do and deal with basically that change. Okay, so now let's go back and we're going to do our first journal entry. We're going to do our consolidation process, but before we do, we will do our consolidation little worksheet over here. So let's do our consolidation worksheet, which will alter our first journal entry. So we're going to alter our first journal entry with this consolidation worksheet. So the way this works is we're going to have the net income. That's what we typically start with, and then we will adjust it for our first journal entry. Then we have the net assets, which we will then adjust in a similar fashion, in essence, the other side of that adjustment. So I'm going to start with net income. I'm going to take that by saying negative of, scrolling on over to the trial balance. We're going to be picking up then the 153,000. Then we're going to break that out in the controlling and non-controlling interest, the 153,000 times the 90% being the controlling interest. And then that 153 times 1 minus that 90% non-controlling interest. Then we got the inventory prior year reversal. Notice we did some of these already with this calculation down below when we did one of these calculations down here. So this will be a similar process. So I'm going to say these two deal with inventory. So we're going to say this is the prior year reversal. Let's pick up the prior year reversal. So that 5,100. And then I'm going to break that out because it was an upstream transaction, breaking it out between the 90 and the 10, controlling, non-controlling interest, 5,100 times the 90%, and then the 5,100 times 1 minus the 90% or 10%. Then we've got the other side of the inventory. This is going to be a negative number for the current year. So current year, bottom line, current year upstream transaction, all the way down below in the blue area, we're looking for that 3,000. That's going to be also broken out 10 or 90-10. So there's the 3,000 times the 90, and then the 3,000 times 1 minus the 90 or 10. 90-10 split. And then we've got the gain on the retirement of the gain on retirement gain. This is going to be that 24,000 because that purchase took place in the current year of the bonds that were issued to somebody else, but they purchased them in the current year. So it's 24,000. So we're going to multiply this. We're going to split this one out as well between the controlling, non-controlling interest, 90%, 10%. There's the 90. There's the 24,000 times 1 minus the 90, or of course the 10%. So then we also have that 6,000, which is the 24,000 divided by 4. Same calculation we did over here. So I'm not going to go over it in detail again. I'm just going to say negative of that number. And maybe I even just pick it up from this calculation over here. It might be easier if you're working with this worksheet to see that. Then I'm going to take the 6,000 times the 90%, then the 6,000 times 1 minus the 90, or the 10%. Now we're just going to add this up column by column equals the sum of the first column. Oh, something happened. Hold on a second. Equals the sum of the first column. Tab. Equals the sum of the second column. Tab. Equals the sum of the third column. You can copy and paste this, but I just want to emphasize that we're like what we're doing. So there we have that. Now these are going to be the same numbers that are going to go down here. I'm going to do them with formulas so you can see them. So I'm going to do this manually, or, you know, kind of tediously, just so you can see where these are coming from. So we're going to say these numbers here, and then we got these are the same numbers here. So there's the middle, there's the meat of it. Then we can sum them up and just see if they total up as we would expect. The beginning balance, this number up here, is going to be the net asset side of things that we're going to adjust, the other side of the journal entry. So that then can be calculated as assets minus liabilities for S, which is going to be that 1,302,000, or equity being that same 1,302,000. Let's start there. That's probably where we should have started. I got kind of ahead of myself, but I got a little excited. So I'm going to say this is going to be equal to the net assets, which is going to be all the green and the orange assets and the liabilities. Going to break that out between the controlling, non-controlling, that being the 90 and the 10%. So we'll take that 1,302,000 times the 90%. Then we'll take that 1,302,000 times 1 minus the 90, which is 10%. Then I'm going to sum these across, summing these two, and summing these two. That didn't work. Equals the summing of those two. That makes it work. Equals the sum. All right, now these three totals should match up to these three, and I'm missing one here. Something is wrong. So I've got this. This should be. I skipped a row. Sorry about that. Equals this. Okay, and then we got one more row. The 6, and then this is equal to the 5,4, and then we'll sum them up this way. So there we have it. So these and these are the same. Now let's sum them up vertically. So we'll sum them up vertically, tab, sum them up vertically, tab, and one more time, vertical summation. All right, so I think that looks good. So there we go. Now we will use this information in order to populate our first consolidation journal entry, which will be exciting. To do that, let's hide some cells to get some of this added information we don't need out of the way. So I'm going to go from I. I'm selecting from I, and I'm going over to T. So we're selecting from I to T, otherwise known as it, the it range. And then I'm going to right-click on that range, and we're going to hide it. Don't delete it. So we will right-click and hide. All right, so now let's enter our transaction. Standard kind of format, but then we'll adjust it with our table to the right. So I'm going to say this is going to be equal to, I'm going to pick up the investment in stock, just normal habit to do that. Then we're going to be picking up our retained earnings information, or our equity section for S, basically removing it. So we're going to take the common stock, then I'm going to copy that on down to the dividends, copy on down. So I'm just copying down to the dividends here, and then let's populate it. So I'm going to say common stock has a credit balance. We're going to do the opposite thing to it, or a debit to remove it, of the 484. The premium has a credit balance. We're going to do the opposite thing to it to remove it. Then we've got the 454 credit balance retained earnings. We're going to do the opposite thing to it to remove it. Then we've got the dividends. It's got a debit in it, so we're going to do the opposite thing, this time being a credit to remove it. So there we have that. Then the next thing we typically will do is we're going to go to the income account, the income from S. This is where things get funny, because we're going to be taking some of this information from the table this time. So normally we would be saying this is going to be the negative of the net income down here, and then we would multiply times the 90% for the controlling interest. And that's what we would have. But now we're going to change it. That's what's in our beginning from our table. But now we have changed that. We have changed that to this number. So I'm going to make it colorful to indicate that, and then change the number to this number. Okay, and then we're going to do the same thing for the non-controlling interest in net income. Once we've made adjustments to these four, it should be in balance. Our journal entry should be in balance with those balancing changes. Okay, so then we're going to say the net income here is usually going to be this times 1 minus, or 10%, the non-controlling interest. That number. And that's what it usually is. But we're going to change that. Here it is on our table. That's like what it usually is. But then we're going to change it to that. And then I'm going to make this green to show that change. And then we're going to change it. So we want that number. That's the 1. All right. Now we're going to reflect the other side of the change in basically the balance sheet side of things. So normally we take these accounts times the controlling and non-controlling interest. So that would be the 1,302,000 or the 1,302,000, and allocate that to controlling interest investment in as stock and the non-controlling interest in the net assets. So normally I would take that net assets. This would be a credit, summing up assets and liabilities and multiplying it times 1 minus the 90%, or of course 10%. So that's what we would normally do, and that would be this number here. Going to change that to orange, but now we're going to be using this number because we've changed it. It's been changed. And so now we're going to be picking up this number. And then finally, normally we would do the same thing up top, or similar thing up top, taking the assets minus the liabilities here. Like so, and then multiplying it times the 90, and that would be this number in our table. But I'm going to make that blue. We're changing it to this number, which I'm going to make blue, and then I'm going to change it up here to indicate the blue stuff is changing this thing, and then negative of that number is what we're picking up. There we go. Now this thing should be in balance. So it's in balance. This middle part now adding up to the 1,322,1, which is our alteration or adjustment basically of the net assets down here. We now have allocated controlling 90, non-controlling 10%. Let's go ahead and post this thing now. Here's our worksheet. Here's parent trial balance, S's trial balance. Let's add them up first by saying equals the sum of these two. Then I'm just going to copy and paste that on down. Copy and paste it on down. Then we can post this thing. So we've got the investment in S stock. So we'll pick that up. We want this to go to 0 at the end of the day. It's not there yet, but we have, we're not too concerned yet. It will get there. We've got faith. Then the common stock is going to be down here. Common stock is going to be down here. And we're going to be, in essence, removing for these equity accounts the S portion, bringing us back to basically the P portion here. So these two match. That's kind of standard practice. We've seen this in the past. If you've seen a few of these, we've done a few of these. Oh, I have. So some people have seen them. And then we're going to say retained earnings. Same kind of process. These then going down. Then the dividends. So we're going to be picking up the dividends. So there's the dividends. Okay. So now we're going to go to the investments. So this is another one that should go to 0. So that's why I'm making it like colorful. Because we want to, when those go to 0, we get excited. So we want to make sure we don't miss it because it's good times. So then we're going to go to the income from S. So income from S. And then we have the non-controlling interest of S. That's going to be down below. Non-controlling interest of S. And then we have the non-controlling interest in the net assets up top. That's in the balance sheet side of things. That should put us back in balance. All right, there we have it. Now let's go to, we're going to think about the goodwill now. Now the goodwill now is something that happened in the current year. It got impaired in the current year. So you'll recall, goodwill we calculated at the point of consolidation to be $50,000, but then in the current year it was said to be impaired by $25,000. It then going down from 50 by 25 to 25. So now we need to record that because that happened in the current year. Now we could do this as we have in prior problems by basically putting the goodwill on the books for 50,000 and then reducing it by the 25 and recording the loss. Or we can kind of do it net. And so let's try to do it basically the net activity that's going to happen. So in other words, goodwill is going to go on the books at the 25 instead of us putting it on at the 50 and then taking off the 25. And then we're going to have to deal with this impairment loss, which we're going to have to allocate to between the controlling and non-controlling interest because there's going to be an adjustment to them as well. Okay, so let's first think about the loss, because if we put this on at 50, then we'd have to take it down by 50. The other side would be a loss, which would be the goodwill, we're going to call a goodwill impairment loss, acting kind of like an expense. Then we'll do the balance sheet side of things, basically putting the goodwill on the books at the net amount now being the 25,000. All right, so we're going to say, let's go to the loss first. I'm going to say this is going to be a goodwill impairment loss. And then I'm going to be breaking that out between the controlling and non-controlling interests for the income statement. Controlling and non-controlling interests. The loss is going to be 25,000. So 25,000 is what it went down by in the current year. So it went down by 25,000 to 25,000. So it's a little confusing. It's the same number, but went down by 25 to 25. Then we're going to be saying, all right, this is going to be the negative of that times the 90%. And then let's say negative of that times the 1 minus the 90, which would be, of course, the 10%. Let's post this thing on out then. Post it on out. We've got the goodwill impairment loss. That's going to be down below goodwill impairment loss. We're going to be picking up then there, that, 25,000. Then there, that, 25,000. Then we got the income from S. Income from S. This is going to go down to 0. This is one of those exciting moments. So we're going to say F2 plus F2. We're going to be picking up that 22.5. And once I hit enter, that's going to go down to 0. Savor it. Savor it. Woo! There it went down. That's what we wanted to see happen. Then we've got the non-controlling interest in the net income. It's going to be down here. We're going to say F2 plus F2, and we're going to pick up that 2,500, so we're back in balance there. Now let's think about the balance sheet side of things. So balance sheet side of things, this would have gone on the books at 50,000, then going back down by the impairment of 25,000, which means goodwill in essence for the total would go up by the net of the 25,000. So let's put the goodwill on the books, calculate it this way, it should be an asset. So we could say it would have gone at the 50,000, and then it got impaired by the 25 down here, minus the 25, bringing it to the 25,000. Now, while we're on balance sheet stuff that we're going to have to change, there was also land that was different. There was a differential in the land at the beginning. It was on the books for an added amount, so the land needs to go up by that differential thing at the beginning of the 30,000. This is something that we would do each year. So we would know this if I looked at the last year's consolidation and be like, yeah, there's the differential for the land. Gotta add that to it every year. And then we're going to take these two and we're going to be breaking it out between the 90-10. So we got the 55,000 going to be breaking out between the 90-10 on the balance sheet side of things for the controlling, non-controlling interest. Controlling interest being to the account of the investment in S stock. Non-controlling interest going to the non-controlling interest in A net assets. Calculated negative sum of these items, going to say times the 90%, times the 90% up top. Then I'll do the same thing here, negative sum of these items times, we're going to say times 1 minus, let's do it this way, the 90%. Be consistent with that. Consistency, it's important. Then we're going to record this one on out. So that adds to 0. That looks good. So let's say the goodwill then. Goodwill is going to be increasing over here. We like the goodwill. There's goodwill and there's a bad will. We like the goodwill. So we're going to be increasing the goodwill. And then we're going to go to the land. There's not really a bad will that I know of. But then we're going to go to the land and we're going to say this equals the 30,000. And then this is going to go to the investment in S. So the investment in S. Up top, not quite to 0 yet, but we're working on it. F2 plus F2, something's in it, so I use the F2 plus F2, 49.5. And then the non-controlling interest in A, net assets, F2 plus F2, It's going to be that 5,500. Does that put us back in balance? It should. It does. Therefore, we'll move on. So now we're going to go to the inventory type of transactions. We have the cost of goods sold is going to have to be increasing for the inventory. So this is a typical kind of inventory transactions. I'm going to be pulling this from our, basically like the other side of the beginning entry table. So in other words, I'm going to be pulling this from this table right here, that 5,100, basically a reversal of the prior year activity, is going to be a credit to cost of goods sold. Then the other side of it is going to be broken out between the balance sheet side of things for the controlling and non-controlling interest, that being then the investment in the stock, and the other side being non-controlling interest in A. Breaking this out, this is going to be negative of that number times the 90%. The 90%, and then I'm going to say negative of that number times, we're going to say 1 minus the 90%. So there we have that. Let's go ahead and post that out. So here's the non-controlling interest, or the cost of goods sold. We're going to bring that on down here. This is going to be equal to the 5,100. We've got the investment in S stock up top. I'm going to say this is going to go to 0. This is a good time. F2 plus F2. Picking up that 5,490. That then brings it down to 0. That's what we want to see happen. And then we're going to go back to the non-controlling interest in NA, net assets, F2 plus F2. We'll pick up that 510. All right, so now let's note that we will have another transaction related to the inventory, which is basically going to be picking up that other portion, the 3,000 here, or include that number, and that will happen at the end. We'll do that at the end. So we will be back to that at the end of the problem. We're going to move to the bonds now. Let's think about our bond transactions. So the bond transactions, we had 2 of these bond activities happening here and the one below. The one up top is the easier of the 2 to deal with because, of course, these mirror each other nicely. So we can, and there's no premium or discount. It happens to be in this one as well, so that makes it a little bit more simplified as well. So let's think about removing this. We can kind of think about this as having a balance sheet side of things and an income statement side of things, and then just simply reversing it. So let's first think about the balance sheet side of things. So we've got the bonds payable is going to be on the books for P, and there's no premium or discount because it was issued at par. And then on the S side of things, they're going to have the investment recorded on their side. We're simply going to reverse them too, those two, them two, and that'll be it. So we're going to then debit the bonds payable, and then we're going to be crediting the investment in P bonds for the amount of the 200,000 debit and the credit. Bonds payable then, let's post it out, bring it on down. Bonds payable is going to be over here. We're going to say this equals the bonds payable on the debit side of things, leaving us just with the 1 million for the other bond. And then we're going to go to the investment and remove the investment as well. So let's remove that. So there we have it. Now let's go ahead and unhide some cells to think about the other side, which is typically interest income and expense. So let's unhide some cells. I'm going to put my cursor on G to U. So I'm going to put left click G to the U. So GU, we're going from GU, and then right click on that area and unhide. And you'll recall we'll say, well, what do we need to reverse? What would they have done with these bonds? They did this. They would have recorded this. If we drill down on these intercompany bonds, we'd say, well, I mean, and again, we lumped them together. But P would have, we lumped journal entries that could happen, a couple during the year and like one or transaction. So, but in any case, they would have had a debit through the year to the interest expense of the 20,000, and then on the other side, they would have interest income of the 20,000, and they mirror each other nicely, and we can just reverse them exactly. So we're just going to say, now we put them over here into other income, so interest income is included in other income. So other income is a credit balance. It would have to go down. And then other expenses includes interest expense, and it would have to go down too with a credit, the amount for the 20,000. So I'll pick up here that 20,000. That's the one. So let's record that. So we've got the other income. Here's the other income. We're going to say this is going to be equal to picking up that 20,000, reducing the other income. Then we have the other expense. So other expense equals decreasing that other expense as well. All right, then we also have the other kind of funny thing that happens over here, and that's going to be this intercompany receivable and payable. So with this middle transaction, you'll see we're left with, we would have an adjusting entry at the end of the year. This would be something we can look up fairly easily, just like through the subledgers, like we would with the receivables for like normal receivables, and see that we owe each other money, and they should be equal and opposite. So we're just going to reverse these, and again, we're going to say that receivables and payables are just included in receivables and payables instead of breaking them out into interest receivable and interest payable and other accounts receivable and whatnot. So it's in the receivables up there. So we got to reverse the payables with a debit because they're credit balance accounts. So we're going to debit them, and then we're going to reverse the receivables by crediting them because the payables are credit balance accounts, so we're going to debit them, and the receivables are debit balance, so we're going to credit them for the amount of, I'm going to say, this 5,000. So that 5,000 needs to be reversed because they're both overstated by that amount. So here's the payable. Payable is going to be reversed. So we're reducing the payable by the 5,000, and then we're going to reverse or reduce the receivable by 5,000 as well. So there we have that, and that'll bring us back in balance. Okay, so now we're going to do the other journal entry, or the other bond transaction, which is the more complex one that doesn't mirror each other exactly. I'm going to ungreen the top one because we're done with that one. We're now looking at this one. We've done some other calculations related to it, and we've also looked at the transactions related to it, which we've said this is going to be P, and this is going to be S with relation to it. So that'll help us with our reversing transaction. Now I'm going to do this all kind of like in one lump sum this time instead of breaking out the balance sheet and the income statement because it's a little bit more, we got to kind of combine them together due to this process to figure out. So in any case, let's take a look at it. We're going to say the bonds payable needs to still go off the books. So I know that much. We're going to say I know that. It's on the books at a credit. So we got to take it off the books by doing the opposite thing to it. Any premium that's still on the books related to these because we know that even though P didn't get distributed the bonds from S directly, we know that they have all of them. So all the premiums need to go off the books, and they're on the books as a credit because they're a premium. So we're going to debit them to take them off the books. So I know that for sure. And then we also know that this account up top related to the investment in S bonds, that's got to go to zero. So I know that's got to go away. So whatever's in there, we know it's got to be removed. So I'm going to say that's got to go, and that's going to be a credit to make it go away. Okay, so then we also have the income and the expenses that we know are going to be involved in these transactions. Income and expenses are going to both be overstated, but not for an equal and opposite amount. So let's first think about the income that's going to have to go down. It's going to be a debit because income's a credit balance. It's going to have to go down by doing the opposite thing to it, a debit. Now we know if we look at the transaction we did up here, that's how we're going to figure out the amount. So we credited for P recorded income of the $125,000. Shouldn't have because, well, it's an intercompany kind of transaction if you put them together. So that's overstated. We need to remove it. We're going to do that with a debit of the $125,000. And then on the other side of things, we got the expense side of things. I'm going to say other expenses. It's going to include the interest expense. That's going to be, and this is the unusual thing, it's not mirrored out exactly. That's the 120, that's going to be the 119,000 that needs to be removed on this side because again, they recorded their item with regards to the premium that was originally issued when they originally issued the bonds. So we're gonna have, that's an interest expense. We're gonna have to reduce it by the 119. They recorded 119, so we're gonna have to reduce that. Now you'll notice the difference between those two is that 6,000, the 6,000, right? Okay, so now we have the gain on the retirement. So the gain on the retirement, because this happened in the current year, P did this purchase of the bonds of S from a third party. And so that's going to be the 24,000 that we calculated here. So I'm going to say that's going to be the 24,000. It's a gain. So I'm going to say negative of that 24,000. So there we have that. And that should do it. So that should do it. Debits then equaling the credits. If we add this up, that looks good. All right. So there we have it. So now let's go ahead and post this out. We got the bonds payable. So we'll go up to the bonds payable up top. So bonds payable. Something's in it. So I'm going to say F2 plus F2. And then go back down to pick up that 1 million. Bring it back on down to 0. Then we got the premium. It's got to go away. So the premium's got to go away. So we'll post that. That should bring it back on down to 0. So there's that. That looks good. Then we've got the investment in S bonds. That's got to go away because these two are related to each other. You can't be invested in yourself. Silly. So we're going to say equals the 985. And then we have the other income. So here's the other income. We're going to reverse that because it's overstated. So F2 plus F2 because something's in it. And we're going to be picking up that 125. And then we have the other expenses, including interest expense. That also is overstated. So I'm going to go in there and say F2 plus F2. And we're going to pick up that 119. And then we've got the gain that we've got to record on the books. We're going to be picking up the gain then for that 24,000. So there we have that. Whew, back in balance. One last thing we got to note, the next thing is not exactly the last thing. There's 2 more journal entries we're going to do from here. Do here, and this is minor compared to everything we've done so far, and that's going to be putting on the payable and receivable related to the bonds that were issued or that were declared but not yet issued. And that we have over here in our last little tidbit down here. It says on December 31st. No, that's not it. That's not it. This one. As of December 31st, declared but not yet paid dividends. So dividends declared, not yet paid. That means that, who declared them? S declared them. So S was going to have a dividends payable on their side, and then on the other side, on P side, you should have we should have a dividends receivable for the amount of their portion of the 90% that are going to be recorded. So we got a payable and receivable that we got to take off the books. We already dealt with the dividends because we saw them declare they would be included in the dividends here, but now we got this payable and receivable thing. And once again, we're just going to lump them together. Okay? And it might be in practice dividends payable and dividends receivable. And we're just going to say they're all lumped into receivables and payables here. So now the payables, once again, which includes dividends payables, needs to go down. So we're going to debit the payables by that amount. And then the receivables, which includes dividends receivable, needs to go down. So we're going to remove that. And the amount's going to be equal to, I'm going to be picking up that 13,250 times the 90%, the portion that's intercompany. And then we'll say that's it. That's going to be it. Let's post that out. And then we'll be done. So we're going to go then the payable over here. Something's in it. So I'm going to say F2 plus F2. And scroll on down to the payable. That 11,925. And then the receivables up top. So there's the receivable. Something's in it. So I'm going to say F2 plus F2. And then scroll on down. Pick up the receivables. There we have that. Decreasing the receivables. And so that looks good. So now there's one more transaction I want to do here that we need to do related to the inventory. So I'm going to highlight this one because we did this half. And you'll recall when we were looking at the inventory, we basically picked up this number, which is this number in our table. Now we want to think about that 3,000. The other side should be this 3,000, or maybe not the other side's the best term, but we typically take the prior year transactions and current year transactions we deal with. Now the other thing that needs to happen is that we've dealt with the cost of goods sold to some degree. We'll have a piece of cost of goods sold in this transaction as well, and then the income is overstated. So we have to reverse the income. So let's do that now. I'm going to say, all right, income is going to be overstated. We're going to debit the income to reverse the income for the intercompany, basically sale or transfer of inventory. That's going to be for the amount of the transfer that took place in the current period because it'll be affecting the current year. So not the prior year activity, but the current year one for the 81,000. That's what happened in the current year. That's the sales amount that took place in the current year. And then the inventory is going to be the other side. That's going to be the other side where we're going to see that 3,000 that we're going to be picking up. And this is kind of a standard format that we're looking at. You could see more explanation on this in the videos and prior presentations when we concentrated on these inventory transactions. I'm going to be picking this up from the table. So picking this up from the table over here, I'm going to say now I'm taking this one. So basically we did 2 journal entries. One included that 5,100. This one now including that 3,000. The 3,000 going to the inventory. The difference between the two, negative sum, is going to be cost of goods sold. So that's going to be the cost of goods sold. I'm picking that up here. Let's go ahead and record that now. I'm going to go to the revenue first. Revenue is going to be reduced by that 81,000. Then we've got the inventory. Inventory up top is going to be equal to the 3,000. And then finally we have the cost of goods sold. So inventory, what's recorded here, we got the cost of goods sold is going to be down below. Something's in it, so I'm going to say F2 plus F2. And we will then pick up that 78,000. Okay, so now we have these two items at 0, so that looks good. We have these bonds at 0, because these are intercompany investments in bonds. Then we have the liabilities that are intercompany bonds, as well as the related premium down to 0. The equity accounts are basically reflecting the parent equity accounts, which is typically the case for the practice problems or consolidation problems we have done thus far.